Take a dollar bill out of your wallet. Hold it for a second. It looks official, serious, almost permanent. There's a seal, fine print, historical faces staring into the distance like they personally guarantee something. Here's the uncomfortable truth. That dollar is not backed by gold. It's not backed by silver. It's not backed by a vault full of anything physical. It's backed by a system. And systems can wobble. For most of modern history, people believed money had to be tied to something tangible. Gold, silver, something you could drop on a table and hear it hit. The logic was simple. If paper represents metal, the paper has limits. You can't print mountains of gold. But today's dollar works differently, and understanding that difference explains a lot about inflation, debt, markets, and why governments behave the way they do. Right now, this matters because global debt is at record highs. Central banks have expanded their balance sheets massively over the last decade, and inflation, once described as transitory, has reshaped how people feel about money itself. The question isn't abstract anymore. People feel it at the grocery store. X. So what actually backs the dollar? The short answer is the U.S. government's power to tax, its legal system, and the fact that everyone agrees to use it. That sounds soft, almost flimsy, but it's more powerful than it sounds. Let's rewind. In 1944, after World War II, the world built a new monetary order. Under the Bretton Woods system, the U.S. dollar was tied to gold at $35 per ounce, and other currencies were tied to the dollar. The dollar became the center of global finance because it was, in theory, redeemable for gold. But there was a problem. The U.S. started spending heavily on wars, social programs, growth. More dollars flowed around the world than there was gold to back. Foreign governments began asking for gold in exchange for their dollars. In 1971, President Nixon made a move that changed money forever. He ended the dollar's convertibility into gold. The gold window closed. It's just like that. The last direct link between the dollar and a physical commodity was gone. The world didn't collapse. Markets didn't shut down. Life went on. Because by then something else had become more important than metal: trust and obligation. Today the dollar is what's called fiat money. That simply means it has value because the government declares it legal tender and because the economy is structured around it. You must pay taxes in dollars. Courts enforce contracts in dollars. Debts are denominated in dollars. You can't pay your U.S. taxes in gold bars, Bitcoin, or sheep. The government wants dollars. That creates constant demand. So the dollar is backed by the government, its authority, and by the productive capacity of the U.S. economy. When people say it's backed by nothing, that's not quite right. It's backed by an entire tax base, legal system, military, and economic engine. But here's where the tension lives. When money was tied to gold, supply had a natural break. With fiat money, that break is political and institutional, not physical. Central banks and governments decide how much money to create, mostly through lending, bond buying, and interest rate policy. And the numbers get big, trillions big. When the Federal Reserve expands its balance sheet, it's not shipping in trucks of metal. It's creating bank reserves electronically. It's that new money moves through financial markets, banks, and the economy. If more money chases the same amount of goods and services, prices tend to rise. That's the part people feel. But from the government's perspective, this system has advantages. It gives flexibility. During crises, authorities can inject liquidity, stabilize markets, and prevent deflationary spirals that used to cause brutal depressions. The irony? The thing that makes the system powerful also makes it fragile. A gold-backed system can run out of metal. A fiat system can run out of credibility. If people believe the government will manage money responsibly, the system works. If they start believing money will be created endlessly to cover deficits without regard for inflation, trust erodes. And money, at its core, is a shared belief. There's another layer: global demand. The dollar isn't just America's money. It's the world's main reserve currency. International trade, commodities like oil, global debt markets, they're heavily dollar-based. Foreign governments and companies need dollars to operate in the global system. That external demand helps support the dollar's value. So your dollar is backed by law, taxation, economic output, and global demand. Not a pile of gold, a network of obligations. But networks can shift. If U.S. debt keeps rising faster than economic growth, if inflation stays unpredictable, If geopolitical tensions push countries to reduce dollar dependence, the structure supporting the dollar faces pressure, not instant collapse. It's more like slow stress on key-beams. Still, it's easy to misunderstand this and imagine the dollar is fake or meaningless. It isn't. Fiat money has powered enormous growth, technological progress, and decades of expanding global trade. A rigid gold system had its own crises, bank runs, and painful deflations. The question isn't whether the dollar is real, it's whether the institutions behind it can maintain discipline and trust over time. Because in the end, the bill in your wallet is a claim. It's not on gold in a vault, but on a future where the US government can tax, the economy can produce, and society continues to accept those green pieces of paper as valuable. That's a different kind of backing, more abstract, more flexible, maybe more dependent on human behavior than we like to admit. So the next time you hold a dollar, you're not holding metal, you're holding a bet. The real question is, how strong is the system that makes everyone else keep believing in it tomorrow?